I really feel like, the market right now is in this, what I call this intervention matrix, right? And
Mm.
I had thought that, given just the terrible earnings in the market, that would be sort of like the red pill to kind of break us out of the matrix. And
Yeah,
right,
yeah.
but I think that, there's still a lot of intervention shenanigans going on.
Welcome, Michael. It's great to have you on the show. So, how are things?
Thanks for having me. Things are looking good here in California. I'm lucky to be in California where we still have somewhat balmy weather. So,
Yeah, yeah, lovely. We were discussing before we got on the call, but it's very different weather here in London. But hopefully it improves, at least stop raining. So we'll return to this question, I think, later on. But perhaps you can briefly explain what is the dollar wrecking ball?
well, so I coined this term a little bit over a year ago, and my concern at the time. So I've been doing a lot of work over the last 7 or 8 years in the oil space. And so I came upon it from a very commodity centric view, because my view, which was out of consensus at the time, was that this structural commodity bull market that has been many years in the making, and but certainly exacerbated by current green energy policies as well as the Ukraine war, was setting up for a perfect storm that would ignite inflation and cause the Fed to start a hiking cycle sooner than everybody else. And that, whereas in the past, typically commodity bull markets have been associated with weak dollar regimes, that this time it would be different. It would be the actual commodity strength itself that would gird the Fed into creating this US dollar wrecking ball. And I label it a wrecking ball because, obviously, as is evident now, most because oil is denominated primarily in U.S. dollars and traded in U.S. dollars, um, and most of the other countries that, especially net importing countries,
Mm.
you know, they they really have a big problem, right? Because if you have a dollar that's strengthening at the same time that dollar denominated oil is strengthening, that's a real double whammy, and we're seeing that, uh, you know, kind of unfold before our eyes right now.
Yeah, absolutely. It's a fascinating theory and one that I want to get back to. I did my homework on it before the call, so I'm keen to explore it further. But before we do,
Yeah.
maybe just to give the rest of the interview some context, let's tackle your background. I read that you traded commodities at J. Aaron or Goldman from 92 to 95. So perhaps you can just give us a sense of what it was like to trade commodities at that time and perhaps highlight a few of the more interesting markets for us.
I mean, I was on a desk called the Goldman Sachs Commodity Index desk, which was then a very nascent product. I think that product maybe got rolled out in 91 or something like that.
Right.
I started trading it in 93. And it was a, Jay Aaron. I have very, very fond memories of Jay Aaron, just from uh, learning to cut one's teeth perspective. It
Hmm.
was it was a tough environment to grow up in, right?
Mm.
As especially as a young person, being on that desk, I had the advantage of touching almost every business within J. Aaron, right? So the
Mm.
GSCI at that time was composed of 22 underlying commodities, but it was cap weighted. So about half of the index was oil and associated products. So from a very, very early vantage point, I realized how important oil was to the world. I mean,
Mm.
I was also able to trade all the other associated commodities, like, softs, cocoa, cotton, live hogs, live cattle, wheat,
Mm.
metals, everything. So it was really fun. It was a great way to get an overview of the macro commodity landscape.
Yeah, great. Well, it sounds pretty formative. I was reading through your, I think it was your about page on Substack, but it told me that you then left Goldman to pursue an MBA in finance from the Wharton School. So, why did you decide to go back into education at that point?
I did well. So I did my undergrad in electrical engineering and computer science. I had wanted to be a video game designer, and when I first when I,
Mm,
and it wasn't until maybe like my senior year in college at Berkeley that I thought, I don't know that I like the engineering and the coding lifestyle, etc. So that's how I initially, when I joined Goldman, I joined as a programmer, and I was designing and writing the currency options software.
right.
So it was a year later that I became a trader. And but after 2 years of trading, as stimulating as it was, I thought, you know what? I really have no fundamental knowledge about the world of finance or economics or anything beyond what I've learned here at the desk. So I
Mm.
chose to go back to business school and major in finance and statistics and
Yeah,
so
cool. Okay, so you get that sort of
yeah,
economic grounding then.
yeah,
And then after business school, you join a company called Canyon Partners, a
yes.
credit-oriented hedge fund. So, I mean, I imagine things happened before this point, but I read that during the time there, you co-founded the Canyon Arbitrage Fund. Perhaps you can just give a sense of what specifically you were looking to arbitrage within that strategy, and yeah, just give us an insight into the fund's approach.
Just a little bridge to that point. I did a very impactful internship at Harvard Management during my summer at Wharton, and
Mm,
it was at that internship that I was exposed to just the much bigger world of all these different types of relative value hedge fund strategies, including
hmm
convertible arbitrage, merger arbitrage, equity long short strategies, etc.
hmm
Right? So that's what because prior to that experience, my entire worldview of what hedge funds were either
mm,
CTAs, right, or macro traders, like Quantum Fund, for instance, right?
yeah,
And
got it.
so it was that internship that broadened my view. Like, wow, there's just so much more that's interesting. And so when I took a job at Canyon, I was a little bit of a fish out of water because Canyon's
Mm,
strategy was totally different than what my background was. Canyon was very steeped, the founders of Canyon or came out of Drexel, super, super smart, fundamental credit and capital structure guys. And my background was more, trading and derivatives, right?
mm,
So what I sought to do there was to try to carve out my own niche, really, right? Because
mm,
I needed to learn credit analysis and capital structure, but I felt that I could also add value given my distinct background from the rest of the professionals there. So I started uh, dabbling in convertibles, convertible arbitrage, etc., and had great success doing it during like from 1998, 99. I wound up uh, putting my thoughts on paper. I wrote an internal white paper. It was entitled Alpha with Asymmetry. And my general thesis was that, okay, so certain strategies like convertible arb, volatility arbitrage, right? These are inherently long gamma strategies, right?
hmm
You don't need a greater fool for you to extract the value, right?
Right.
Um, and then there's certain other strategies, like for instance, merger arbitrage that have inherently short gamma dynamics. And so my thought, and I viewed this as kind of almost like a business plan that I presented to partners. I said, what if I could create a business that had a combination of the two, and the long and short gamma characteristics kind of act as systemic hedges, but through proper
hmm
position selection, I could wind up coming out winning on both sides, right? And
mm,
but it was also a lucky time to be involved there because remember when I joined Canyon, I joined Canyon in the fall of 1997, just when the
hmm
beginnings of what I call the first Asian contagion started happening, right?
mm,
So, so you know, I was able to exercise some of my derivative skills to help hedge some equity portfolios during that very volatile period. And then when LTCM blew up and created all this contagion in credit markets, so and convertible markets,
Yeah.
by association, and in the risk arbitrage markets, I was directly able to put both sides of my sort of alpha with asymmetry thesis to work. And
Hmm.
anyways, so that's how the Canyon Capital Arbitrage Fund started. I think we started that fund officially in 2001, but I had already been kind of running that strategy within Canyon's overall fund for probably about 2 years at that point. Um,
Yeah, got it.
yeah,
Yeah, it's really interesting. How old were you, out of interest, when you sort of
uh,
co-founded that strategy?
I was 30, 30.
Yeah. Okay, great. Um, and it seems as if, and maybe I'm kind of taking a leap here, but all of those experiences, I guess you were keen to culminate in a strategy and a kind of an investment firm of your own, because in 2002 you leave Canyon to launch your own investment firm, as I say, Acanthos Capital.
Right,
Um,
right.
so why strike out on your own at that point? Was there a
You know,
eureka moment, perhaps?
it was always something that I had wanted to do. My parents were entrepreneurs growing up,
Yeah.
and I always thought, at some point I wanted to strike out on my own, and I have nothing but the greatest of respect for the founders of Canyon, and still remain very good friends with them today. So I left on very good
Mm,
terms, but it was something I just needed to do, and
yeah.
yeah, and so as luck would have it, I think the year prior I had met I guess, a friendly competitor that was more of a volatility arb type of arb, whereas
Hmm.
my experience out of a Canyon had been one more that was more gravitated towards credit and
Hmm.
understanding capital structure. So that was the genesis. I wound up getting like 100 million of seed capital back
Hmm.
then, which was a big number for back then for a fund launch
Mm,
back in
yeah, yeah,
2002. And then yeah, so then we were off to the races, and I ran it
yeah,
for
great. And how
17
would
years.
you? Yeah, yeah, I read that. I mean, how would you characterize the fund sort of or the firm, sorry, strategy or philosophy, if you could sum it up and give us the
It,
elevator pitch?
so it evolved. I would say that for the first from 2002 to about 2009, okay, we
Hmm.
were we were a very what our investors would have how they would have characterized us was that we were very creative convert and capital structure arbs. So by
Hmm.
creative, meaning that if you think about the standard convertible arbitrageur as being long converts and short stock and sometimes hedge out the credit with CDS, right? We would do things like, well, sometimes we might be long a convert and short a straight bond and have no stock hedge, or sometimes we might
Mm,
be, long a convert and short another convert. And I always viewed, this is where I kind of liken putting some of these creative trades together as almost like computer programming. Like the two of them share a lot in common to me because it's a way of creatively problem solving, right? And here the problem is, how do I express the most asymmetric bet within a capital structure? So I say that was our primary focus from 2002 to 2009. And what happened in 2009, obviously, was the great financial crisis, 2008.
mm,
So a lot of my trades were required the ability to margin, right? To be able to hold on to these different types of capital structure pieces and be able to margin the prime broker's balance sheet. After 2008, that pretty much disappeared, right?
mm,
So it became much more difficult and expensive from a balance sheet perspective to maintain some of these really interesting structural bets I had on. And so we became more, I guess, directional and more
Hmm.
distress oriented, because certainly in the wake of the great financial crisis, the real juice was in distressed securities, right?
Yeah.
And so by dint of our capital structure experience, that was our how we kind of gravitated into that. So I think from 2009 all the way to kind of 2018, I would say that we then became a capital structure agnostic value
Hmm.
investor, right? So what that means
Hmm.
is, we would look up and down the capital structure for the most asymmetric ways to play it. And I used to think of my portfolio as a portfolio of diversified fulcrum securities. Do you know what I mean by,
Hmm.
yeah? So the fulcrum security, just to define it for your audience, is that part of the capital structure where even a small change in the overall enterprise value can result in a
Hmm.
very asymmetric change in the fulcrum, right? So in a very levered company, the fulcrum could be the equity, but in a company that's in distress, right, the equity could be wiped out, and the fulcrum could be the convertible bonds, or it could be
Hmm.
some debt tranche. So we always liked to find that point, that fulcrum point in the capital structure, and bet there. So that's what we did for the next, 8 or 9 years or something like that.
Yeah, and to get us towards present day, I guess, I think you
Yeah.
stopped taking outside investment at the end of 2018. Yeah, why was that? Were you keen to pursue other interests? How did that come about?
So from the period of like 2014 and I would say 2018, we were heavily involved in the distressed energy sector, which, as you know,
Yeah.
that area was like very, very challenging, right? And so ultimately, I think that I'll call it the in Q4 of 2018. You may remember that I call it the Trump rug pull. So he basically Trump basically had pulled us out of the JCPOA, right? And oil was the supply situation in oil was starting to tighten up. And then at the same
Mm,
time, he begged Saudi Arabia to basically flood the market with oil in anticipation of, no sanctions, or sorry, no
mm,
sanction waivers, right? And then,
right.
of course, as the barrels were headed over, he grants 11 waivers and market collapses. And I remember at that point, I was thinking to myself, okay, you know what? I've done all the micro analysis for the companies that we follow, done all the macro analysis, and yet, like, this type of random thing happened, and I felt like
Mm,
not only did I have no edge at that point, I felt, you know what, I'm just burned out. I'm
mm,
burned out.
yeah, yeah.
So the very last big deal that my firm participated in, which comprises a very big personal bet for me even to this day, is the restructuring of a company that was called Brightburn. It was an upstream MLP that was very levered and went bankrupt in 2016 and was in a
Hmm.
very contentious Chapter 11 for almost 28 months. And
Mm,
so, long story short, we, along with I think 9 or 10 other hedge funds led by Elliott Management, wound
hmm.
up coming to a deal with the second liens where we carved up the company. The second lien holders wound up getting the legacy assets, and we unsecured bondholders wound up buying out the sort of what we viewed as the crown jewel of the company, which was a
Hmm.
big contiguous block in the Permian Basin. And
Mm,
so, thus embarked my journey on, being involved in starting a brand new company. Essentially, we
mm,
infused this company with fresh capital, brought in a new management team, and it really opened my eyes to. And so at that point, I had decided to shut the remainder of my fund and essentially just keep this one piece. where I would
Yeah.
be, kind of somewhat directly involved. And, to this day, I probably have, daily conversations with the management team there. And so I have kind of a
Cool.
quasi insider's look into the industry. And that's been really, really fun. But it also highlighted something very, very important, which is, so one of the issues that I had during that I learned in that 2014 to, call it 20, even 2020 um, protracted bear market in oil,
Mm,
was the difficulty of getting uh, both the micro and the macro right. And even if you got both right, even if you got the macro right, sometimes you get bit in the ass on the micro, because
mm,
there were management teams, especially back then, that were very that did not look at what we call full cycle returns, right? They'll tell you
mm,
how great their well level IRRs are, but the thing is, the free cash flow was never forthcoming, because they kept redeploying that free cash flow into worse and worse acreage, right? So
mm,
I call that capital reallocation risk, which is
mm,
a perhaps less of a problem today, because I think a lot of the sector has found religion in terms of more capital discipline and shareholder return. But
right.
when we started this new company, that we had a very, very specific model in mind that differed from the public's, and that is, we said, okay, you know what? We have a fabulous piece of acreage that represents a finite resource, and we're going to fully harvest it. We're not going to have capital reallocation risk, and
Mm,
we're going to see this through in terms of full cycle returns, right? So we basically started the company back in 2018. It's now been, I guess, just about 5 years, 4 years,
mm,
almost 5 years, and we're now to the point where, it's a company that is producing a substantial amount of barrels per day and cash flow, and
mm,
it's a good place to be, because I've had this long-standing view that this commodity, um, this that there is a structural bull market in the commodity sector, and we can talk about that if you'd like. But that
mm,
that view, that commodity centric view, is what informs a lot of my overall macro views that have extended to,
mm.
obviously, like the dollar and things like that. So
Yeah, fascinating. I didn't know
yeah,
about a lot of that, so that's really
yeah,
interesting to know.
yeah.
And there are a few points I want to return to, but I guess if we just round your kind of career history section off, present day, you're writing about financial markets on your blog, Cowboy Musings. How would you sum up the blog style? Because when I read it, it felt pretty differentiated to some of the other stuff I've read on Substack by some of your peers. So how would you sum up the style?
Well, first of all, I'm not plugging my Substack at all, because I really haven't updated it. And I started, okay, so after I officially returned my outside money in early 2019,
Mm,
I realized, wait, so I still love financial markets. I just don't really want to be an active fiduciary anymore, right? So how
yeah.
does one sort of stay engaged and stay relevant? So I started tooling around with like a blog, and wrote a bunch of pieces on it, which I've now put onto Substack. But what I found was, it was kind of frustrating. I had a distribution list of maybe like 400 people that I sent it to, and I'd spend like
Mm,
hours or days on some piece, and I maybe get like 5 messages back, right? So I'm
mm,
like, okay, this is not really rewarding, because what I miss was the engagement with smart people, and then I
yeah.
discovered Twitter about 2 years ago, right? So
Yeah.
so I predominantly tweet about things. The Substack that you see is dated. I just have it up there, but maybe someday I'll get to it. But Twitter for me has been very eye-opening, because one of my concerns after dismantling my team, and just sort of being like a lone gun, if you will, was boy,
Mm,
how am I going to be as in the loop? And
Yeah.
because what I found is that if you put out quality content, unbiased quality content, like unbiased. Obviously, I have my own bias, market biases. What I mean by unbiased is that I'm not out there trying to sell a product or a service. I don't sell
Mm,
any sort of subscriptions. I'm not out there trying to raise money. So I'm just putting out stuff out there that I believe. I'm not trying to pitch
mhm.
anything, and I don't pitch individual stocks, right? So
No.
I don't want to ever be known as a sort of a, a stock pumper, right?
Mhm.
But what I found is that when you put yourself out there like that, you attract other really smart people, and they actually help me um, sort of sharpen my own thesis, if you will,
Mhm.
or shoot it down in some cases, right?
Yeah, yeah.
So it's been very rewarding, and because of Twitter, been well, I wouldn't have met you if it weren't for Twitter, right?
No, absolutely not.
So getting these opportunities to speak to different folks has been the most fun I've had in a while.
Yeah, yeah. No, we owe a lot to Twitter. I was talking, I mean, probably to people that you're aware of. I think we've got Doomberg that I spoke to a couple of weeks ago. That episode's out, or came out today. We spoke to Grant Williams, previously of Real Vision. Like, there's this whole sort of
Yep,
FinTwit community that we've
yep.
we've
No,
tried to embed ourselves within because I think there's so many fascinating people there.
I've done podcasts with all of those guys. Yeah,
Mm,
yeah.
mm. Um, Great. All right. Well, let's return to the dollar wrecking ball. We've kind of skirted
Sure.
around it, and obviously there was a nice overview at the start. But this year, the US dollar has appreciated significantly against a basket of international currencies, including the pound, which I'm well aware of, the euro, and the Chinese yuan. Perhaps we can start with the macro factors feeding dollar strength at the moment. Which, in your opinion, are the most significant?
Okay, so so obviously you know about Brent Johnson's milkshake theory, and
Yeah.
a couple of weeks ago we did I think Dimitri Kofinas hosted a space where we
Yeah.
were both on there, and what I found really interesting is that I think we came at this from different angles, and yet
Hmm.
kind of arrive at the same place, right? So my dollar wrecking ball thesis, as I alluded to at the very, very beginning, stems from this observation that what started off as a commodity oil specific inflation, then it Pandora's box, so to speak, got left open too long by the Fed, and that leapt into much stickier components of inflation. And now we've got this full inflation conflagration, if you will,
Hmm.
that's led the Fed to be much more aggressive on hikes than the rest of the world. And at the time, it was a very much an out of consensus bet. Now it feels somewhat of a crowded bet, to be honest with you. But yet, you've seen the DXY take a bit of a breather over the last several weeks. I attribute that partially to direct interventions and what I call picture painting by
Yeah.
banks like the BOJ and PBOC, for instance. And part of
Hmm.
it is also driven by this notion that perhaps the Fed is getting to the point where they need to step down or slow down their policy. But one variant view I that I have, I think, is that I think don't confuse a pause in the dollar wrecking ball as a secular top. To me, I don't necessarily think the secular top in the dollar wrecking ball comes until we arrive at a point where the other big global economic blocks are in a relatively stronger economic position that will allow their central banks to outhawk the Fed. Because in fact, I wrote in a tweet yesterday that I said, look, um, if macro conditions in the world got so bad as to make our Fed blink and actually pause like today, well, then those
Mhm.
same economic conditions have likely already tipped the rest of the world into full-blown easing mode. And you're kind of already seeing that, frankly, right? Because if you see what the Bank of England had to do in the gilt market, right? They were forced from QT to QE to defend the pension system.
Mhm.
And the latest thread that I wrote, I called it, the geopolitical mosh pit,
Mhm.
is this contention that I have that, when you have a world of structural inflation, um, it creates a rift between different central banks and their incentives, because what is good for the Bank of England is not necessarily good for the Fed. What is good
Mhm.
for the Bank of Japan certainly is not good for the Fed. So it creates an every man for himself dynamic where I think, when you see these central bank interventions, especially in their bond markets, leading to a risk rally here, thinking that our Fed is going to start to do the same thing. I think that's a very sort of dangerous line of reasoning, because I think that our Fed here is is focused on the primary mandate of taking inflation down right now. And
Mhm.
what
Mhm.
we're, in fact, this latest bout of sort of risk rip, I call it, is to me a direct replay of what happened in July,
Mhm.
when the Bank of Japan first, there were rumors that seemed to be borne out by the charts, but the rumors were that the bank, when the yen first hit 137, the Bank of Japan essentially asked the Fed uh, for help, and the Fed allowed the Bank of Japan to basically buy our 10 years to essentially paint a picture of a Fed pivot or something like that. And so
Mhm.
what you then saw was like this huge, multiple weeks long risk rip in bonds, specifically the 10-year, in equities, etc. And then
Mhm.
when that came to an end, as we all know, the yen broke to new lows, and then the 10-year and the entire yield curve kind of, gave up the ghost. So I think
Mhm.
right now, I think we are yet in another bout of that, and it's somewhat of a confusing time in the markets, but because there's a lot of what I call picture painting going on.
Yeah. Yeah, I can agree more with the picture painting point. It does feel like there's a lot of that about. Um, we kind of touched on the end game there, but maybe if we take it back to the start, why is this happening to the dollar? What inherent characteristics or traits does the dollar have that other currencies don't?
Well, there are so many. I think the the standard response that we've got a balance of payments issue, and that our debt to GDP is at a certain level, which means that the dollar is doomed to fail. Well, the problem I've always had with that line of reasoning is that, when you're talking about a world of fiat currency against fiat currency, right? It's all relative, right?
Mm.
So what if you think about the insults that have been heaped on the dollar, you can consider no greater insult than what our own Fed has done over the last 2 to 3 years, right? By expanding the
Mm.
balance sheet by like 6 trillion, and essentially conduct an overt weak dollar policy. And yet during that
Yeah.
period, the DXY went no lower than really around 90, 88, 90, something like that, right?
Hmm.
And that was that was during a time where it was an overt weak dollar policy. Now I posit that, so when you talk about, this is what Dimitri Kovinas, he was asking about, endogenous factors and exogenous factors, right?
Yeah.
And
Yeah.
so my answer to that question is that some of the endogenous factors that lend the U.S. dollar inherent strength are unparalleled geopolitical advantages, right? So
Hmm.
from a pure geographic standpoint, to borrow some of the Peter Zeihan and Tim Marshall analogies, right?
Mm.
The U.S. is kind of an accidental superpower in that it's got these twin oceanic buffers, two friendly buffer states to the north and south, this massive contiguous land in the center with per capita arable land acreage that's
Mm-hmm.
like 15 times that of China, not to mention the whole riverine network, etc. So these are things, and when I put on my sort of capital structure, my corporate capital structure hat, I think of this as the left side of the balance sheet, right? So
Mm.
in my world of distressed, and you're thinking about the end game of a corporation, right? And going through a bankruptcy, which I've participated in many of these restructurings.
Mm.
When debt gets wiped out and gets converted to post reorg equity, what determines where the fulcrum security is in a capital structure is the asset side of the balance sheet, right?
Mm.
And so when you think about what the end game is, if we really go down a sort of sovereign debt crisis, right? Even in that scenario, I would say that the U.S. dollar, if you view it purely as from a restructuring perspective, it still comes out ahead because of the portfolio of geographic assets that the U.S. has vis-a-vis the rest of the world, right? So
Mm.
to me, you cannot just look at some of these uh, metrics, these, like, for instance, like debt to GDP, things like that, without considering what that is. And then there's also the hard and soft power, some of the qualitative factors, right, behind
Yeah.
the dollar, and also the inherent depth and liquidity of the underlying bond markets, right, which is very,
Mm-hmm.
very important.
Mm.
Something that I think is very important to also mention is that, yes, when Bretton Woods was signed, um, there was this notion that there would be this sort of dollar-based world order, but
Mm-hmm.
it's not as if there are these overlords that can control the puppet strings and force everybody to use the dollar against their will. The market
Mm.
has chosen the dollar, right? It's an organic
Yeah.
process, and if there were a much better alternative to the dollar, you'd already see it. And
Mm.
what I think is interesting is when you look at the euro, for instance, the euro to date has been the most successful experiment to wrest hegemony away from the dollar. And yet
Yeah.
to me right now, the euro is at the greatest point of fracture risk we've seen since its creation, in my opinion,
Mm-hmm.
primarily because
Mm-hmm.
of again, it revolves back to energy, right?
Yeah.
Energy has a lot to do with this. And I think that when you have monetary union without political union, it's creating all of these rifts. And so now, if you think about the complex world that we live in, this is truly a geopolitical mosh pit. We've got the
Mm-hmm.
Fed uh, at odds, essentially. All of the other central banks are trying to keep their brave faces on and keep pace with the Fed. The ECB just raised
Mm.
75 basis points today, right? But I posit that the ECB just can't keep up with the Fed, right?
No.
Their equivalent dot plots indicate that their terminal rate's going to be around like 275. Well, good luck with that. They're at 1.5 right now. They're already buckling.
Mm.
And I think that the Fed has a more of an ability to reach 5% than the ECB has an ability to reach two and three quarters. So it
Mm.
comes, and
Mm.
so this comes to the exogenous reasons for dollar strength. The exogenous reasons have to do with cyclical and relative economic strength. And right now, if you consider, like, if you look at the U.S. economic zone versus the European economic zone versus the Asian economic zone, the other two economic zones cyclically are also on the back foot relative to the US right now.
Hmm.
So right now, I see that there are both the endogenous and the exogenous factors are lending dollar strength, if you follow.
Yeah, yeah, absolutely. And I mean, there's a couple of points I want to follow up on there. Firstly, the fragility of the European project. That's something that Grant Williams emphasized in the conversation that we had with him. So I'll post that episode in the episode description just so people can check that out. But I'm also interested just to follow up on kind of that organic choosing of the dollar by not just the US, but everyone else around the world almost. That's something I think Brent talked about when I think a line from the conversation you had with him on Dimitri's show was something along the lines of, who captures the money is more important than who actually prints the money. But perhaps you can explain exactly what he meant by that, and obviously if there's any if you disagree with that to a certain extent, or you have a different take or a different interpretation on that, I'd like to hear that as well.
Well, I mean, I think, you know, I'm trying to recall what Brent said in that conversation, but I believe he was saying that, capital will flow to where it's treated best, right?
Yeah, exactly. Yeah.
Right. And so I think if when you consider the whole, you know, panoply of reasons why one would choose the dollar, if you're sovereign country XYZ, and let's pretend that you have no entanglements right now with any currency, and you wanted to see, okay, well, you know what, I need to I need to put my reserves into the dollar or the euro or the yen or the yuan, right? These are
Hmm.
the dollar's primary fiat competitors. Well, I would want to consider all of those endogenous and exogenous factors, right? But also, I would want to consider the practical components in terms of adoption, liquidity,
Hmm.
underlying bond market liquidity. So if you think about, again, a lot of the dollar doomsayers, it will say, first a year ago, the big hyperventilation was around, oh, we're gonna go the way of Weimar, and dollars doomed based on debt to GDP metrics. Then it became, the dollar is doomed based on, weaponization of the dollar because we froze,
Yeah.
Russian central bank assets, etc. So I agree. Like, a lot of these things don't aren't necessarily like friendly, right? But again,
Hmm.
everything is relative. Do you
Hmm.
so would you consider um, having your reserves in the um, Chinese yuan safer?
Hmm.
Right? Right? Do you think that having your reserves in a non-convertible currency that is overseen by Xi, that just pulled a Palpatine move last week, is that actually safer? Does
Yeah.
Saudi Arabia, who, by the way, Saudi Arabia, doesn't like our administration. It's pretty obvious, right? Does not like
Mm.
the current
Mm.
administration. And so you would think that they have every incentive to move away from a dollar standard. And yet the
Yeah.
Saudi Arabian real has always been dollar pegged. And
Hmm.
so are they going to feel that strongly to stick it to Biden that, you know what, we're just going to put all of our wealth, sovereign wealth, into the yuan or the ruble? I don't think so. I don't think so.
No.
I think I
No.
think I think pragmatism wins out beyond, sort of, personal frustrations with, and that's another thing, right? So whether you like it or not, the US system, you could argue that the US political system is both a blessing and a curse. It's a curse because it's a 4-year presidential term and it leads to inconsistent foreign policy choices from administration to
Yeah.
administration. And it's a huge source of frustration um, for a lot of countries, right? But
Yeah.
that's also its blessing, right? Because, hey, whatever beefs Saudi Arabia might have with the current administration, that could completely change in 2 years.
Hmm.
Like once
Hmm.
again, right? So for all of these reasons, this is why I think like Peter Zehan's point that the U.S. is an accidental superpower. I love that phrase because it kind of is in a way, because if you think about our sort of federalist capitalist system, it's not the most efficient um, uh, way of doing things. Certainly, I
Mm.
mean, when you view our system in contrast with authoritarian measures of locking down during COVID,
Yeah.
a federalist capital system was very, very ineffectual in locking its citizens down. But
Hmm.
yet, who's having the last laugh now, right? When you've got like the those same authoritarian regimes now still in quasi permanent lockdown, and the West has effectively gotten out of that.
Hmm.
So
Hmm.
it's kind of interesting, I think, the resilience of
Yeah.
that system, even though it from time to time it may seem inferior to authoritarian regimes.
Hmm.
Over the longer run, it seems like it's uh, a much more stable system, which again feeds into why the dollar, right? Why the dollar is the preferred
Yeah.
vehicle of safety for most central banks around the world.
Yeah, yeah, absolutely. And we've kind of returned to the dollar there, so we might as well finish with I think the question that a lot of listeners are going to be asking, but how long is this historic dollar strength going to last? When can they expect that to end?
It's so hard right now because I really feel like the market right now is in this what I call this intervention matrix, right? And
Mm,
I had thought that given just the terrible earnings in the market, that would be sort of like the red pill to kind of break us out of the matrix. And
yeah,
right,
yeah,
but I think that there's still a lot of intervention shenanigans going on right now. I'm hesitant uh, to attach like a specific price target for the dollar. I always like to say I'd rather be sort of generally accurate on direction than precisely wrong on specific targets, right?
yeah.
But I do think that we have not. I do think that we have not seen the secular top in the dollar,
Hmm.
because again, I think the key question to answer is when will other central banks have underlying economies strong enough such that they can either out-hawk the Fed, or comparatively, right? Are are we going to, is something going to happen that makes the US economy so much weaker than the rest of the world that we're going to start out easing the rest of the world? I just can't really see that happening right now. And um, so that's not to say nothing moves in a straight line forever. And I recognize that the dollar strength has been pretty extreme this year. But
Hmm.
I'll point us back to like the 1985 Plaza Accords, right? So the DXY equivalent for when the Plaza Accords actually happened was something like 165, and currently we
Hmm.
have DXY at 110, right? And everybody's already ready to call the top in the dollar. The other important observation is that who was a willing and signatory to those Plaza Accords to make it happen? The U.S., right?
Mm.
So the U.S. at that point was one of the willing volunteers to weaken the dollar. Um, right now, I would posit that I'm not sure it's even in the US's geopolitical interest to see a weaker dollar, because
Mm.
this is kind of an unpopular question to ask. But I posed this in my at the end of my sort of geopolitical mosh pit thread. I said, so to borrow Peter Zehan's analogy once again about you know so after World War II, if you think about it, right, the U.S. the Bretton Woods world order that was set up was sort of like a quid pro quo. It was sort of like, okay, well, we have the Marshall Plan. We're gonna help rebuild the economies of Europe, and in return, we're going to subsidize, sort of global maritime security, but everybody transacts on the dollar. That was sort of the broad brushes, right, of the
mm,
agreement. And obviously, the market, the markets have chosen the dollar for its own reasons. But what's interesting, that Zehan pointed out, is that you have the beneficiaries of that system weren't just our allies in Europe, but have
mm,
been, for instance, like China. China
yeah,
has become an overt hostile to the West, and yet they've been one of the biggest beneficiaries of that system.
mm,
Even the Eurozone, right, which is the US's ally, created a competing bloc, right,
mm,
in the form of the euro. So the unpopular question I ask is, you know, if the the if the strong dollar here, in the in the name of fighting inflation, if the Fed happens to create a strong dollar that both devalues its all of its competition, would the powers that be, from a geopolitical and realpolitik perspective, really have that big of an objection? I posit probably no.
mm,
So I I think that's, and I'm not advocating one view or another. I'm observing
no,
that I
mm,
think that is the real politic uh, behind it right now, because the
mm,
what drove the Plaza Accords was that the U.S. actively wanted to see a weaker dollar. I'm not sure that the U.S. actively wants that right now with DXY at
mm, mm. Yeah, completely see what you mean. And I think I wanted to finish on a kind of clear, concise, actionable insight that our listeners could go away with, and I don't think I could have asked for a better one than that. And certainly a question to ponder on that real polity point. But I like to finish every episode with more generic quick-fire questions. So these are always the same for
10.
every guest that we have on. So perhaps we can
Okay,
finish there.
sure.
Firstly, what is the most frequent mistake investors make, do you think?
Um, I would say chasing FOMO, chasing FOMO
Hmm.
trades. I mean, I think that my own greatest mistakes as an investor were born out of FOMO, where I'm I'm so worried about missing out. I either hang on to a loss too long, or I get into a trade for the wrong reasons. So I think
Hmm.
I'd like to think that now that I'm older and wiser and have been through many cycles, I'm more conscious of that. But no one's perfect, right? So sometimes I still catch myself with that, and I'm quicker to pull the ripcord on something if I think that I got into it for the wrong reason, namely FOMO.
Yeah, absolutely. And with an
Yeah.
infinite number of media sources sort of re-emphasizing similar points, that's only going to increase.
Yeah.
And we've certainly seen a lot of that in the last few years.
Oh,
Completely agree. Okay, question
tremendous.
two. We like to get an idea of where guests are going to read financial or investment content. So is there specific economic or investment publishers you read regularly?
Well, I consume a huge amount of financial media. Just from just standard news sources. FinTwit is a big one. I listen to a
Yeah.
ton of podcasts, but then I also, one thing that I'm a little bit frustrated at is, like, right lately, there's been so much sort of topical news flow that I haven't been able to read as many books.
Hmm.
So like, usually, my goal for a year is to read at least like 30 to 40 books, and this year I'm maybe at around like 20. So I'm like so the long form, my consumption of short form content is way up this year compared to my long form content.
Mhm.
And I need to balance that out a little bit. It's a little bit of a struggle this year because there's just so much, so
Yeah,
much,
yeah,
current event type stuff.
yeah. Well, I think
Yeah.
that long form, short form imbalance is probably indicative of the way markets have been
Yeah,
for the last sort of
but
year
I
or so.
think but the long form stuff, especially as it pertains to financial history, I think is really important to read because history doesn't repeat itself, but it does rhyme quite often. And
Yeah.
so yeah, I'm a prolific reader, and I also think that you have to. I tweeted this out the other day. I said that when I used to hire for my team, I didn't just look for people with like analytical left brain skills. I wanted people
Mhm.
with right brain skills too. So I think it's very important to um, read material from other disciplines and other mental models. So, every
Mhm.
once in a while I'll go on a deep tangent. I'm a very curious person. So, I think like one
Mm.
year I read three books on like, cephalopod intelligence. And
Wow.
one year I, did a big deep dive on like, quantum mechanics and stuff like that. So I go off on these tangents, but to me, it's never wasted because it helps you
No.
build mental models from completely different disciplines that help you think out of the box.
Yeah. Yeah, completely agree. But you're way up on me if you've already read 20 books this year. Okay, third question. What is the most memorable moment from your career to date? If it, is there one particular moment or highlight that stands out to you when you think back?
Memorable moment. Wow. Maybe let's narrow that a little bit. Memorable moment. You mean from a lesson learned standpoint, or now you stumped
Typically, it
me.
does seem to. Yeah, I mean, to be fair, usually it does tend to be that a particular kind of market or market event that a lot of the time went the wrong way and they learned a particular lesson from that. That does come up a lot. But pretty open to anything. But
Yeah,
that does tend to be
yeah.
where it comes
Okay,
from.
okay. So I have a good answer to this. So poker players are are very good. If you've read Annie Duke's book, Thinking in Bets,
Hmm.
she
Yeah, yeah.
she she makes a very important distinction between separating the decision from the result, right?
Hmm.
And so um, usually people will say, there's a standard refrain that people like to use: better lucky than smart, right?
Hmm.
So
Hmm.
like, people obviously are happy to blunder into a profitable trade, uh, e- uh, even if it wasn't necessarily for the original reason that they put on the trade.
Hmm.
And I would say, just from my own life experience and in being in finance for so long, I would say that sometimes if you blunder into a wildly successful trade, but don't acknowledge the fact that you actually force gumped yourself into it, okay?
Hmm. Hmm.
That 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 lesson that you might learn a very bad lesson from it and wind up paying multiples of your lucky gains. So
Hmm.
that
Hmm.
I would say that's one of the most important lessons that I've learned, is that
Yeah.
you have to separate the decision from the result, even when it means that you lucked out and you made money, but for the wrong reason. You have to
Hmm.
be very careful, and and acknowledge the fact that, okay, well, maybe in this case you got you made the money, but you made it for the wrong reason, and don't
Hmm.
extrapolate from that. And
Yeah.
especially coming off of the era, and how that's relevant in today's world, is that we're coming
Hmm.
off the era of 4 decades of essentially endless liquidity lottery, right?
Yeah. Yeah.
And I would say that many asset classes have uh, confused a bull market with investment genius,
Hmm.
right? and that bull market being primarily fueled by, you know, the lack of structural inflation allowing the Fed to paper over every financial crisis there is. And so
Mm.
I really think that, you know, as a nice bookend to this interview is that I think the biggest worry that I have is um, just recency bias and being able to zoom out and not to necessarily assume that you know, lucky gains were the result of investment genius.
Yeah, yeah, no, I completely agree, and I think that's going to resonate with a few listeners as well, for sure. No, I think that is the perfect bookend and the perfect place to end. That just leaves me to say thank you very much for joining us on Opto Sessions, Michael. It's been a real
Oh,
pleasure.
thank you. Yeah, likewise. Thank you very much for having me.